Welcome to Real Estate 411. I'm Jay Donahue, and I'm here with Steve Tomaselli. And often over the last few years, a question that has arisen and asked of me quite a bit is, what happened to this real estate market that was at one point so robust and is now sort of just bouncing along, and people want to know, and who do they blame, etc. And Steve is a guy that I've met who has a really good handle on this, and I thought it'd be great to bring him in and talk to him about that. So, Steve, why don't you tell us a little bit about yourself?
Sure. My name is Steve Tomaselli. I'm a branch manager with Prime Lending, and Prime Lending is based out of Dallas, Texas, where we've got an office that's opening up here soon in Massachusetts. And I've been in the mortgage business since 1993, and I think that makes me going on 18 years now. So I've kind of seen a lot of the different parts of the roller coaster, the ups, the downs, the slow periods before you hit the highs or the lows. So I've seen a lot of different things in this market. And over the last couple of years, we've seen a lot of the lows. I think right now we're in one of the flat periods, hopefully before we start to get on an upward trend.
Yeah, you certainly, 1993 was certainly...
I really think what got us to this place where we're at were some of the changes that took place in the 1990s. That was when the stock market really started to percolate and do well. And one of the stocks that was particularly hot was Fannie Mae. Fannie Mae was a really high-flying stock, and in order to keep that stock momentum going, one of their goals was to really increase the level of homeownership in the country. When you combine that with some of the legislative changes that took place that affected the way mortgages were underwritten in the late 1990s, specifically affecting the CRA, or the Community Reinvestment Act, that really had an impact on loosening the standards for underwriting. And both Fannie Mae and its cousin company, Freddie Mac, really tried to computerize underwriting and take some of the human element out of it, so that as long as the computer said that a loan was good, it didn't really matter what a person thought. They couldn't overturn the computer's decision. And the rest of the market kind of went along with it.
So in the late 90s, there was legislation where the government told the banks to, let's loosen up, let's lend some more money and get more people into homes. And of course, I think we all agree that home ownership is a laudable goal. And I think that's interesting too, because, from my perspective, 1997, 1998 was really the beginning of that boom market. And I know myself, bought my first house in Dedham in December of '97 and paid $137,000 for that home. 5 years later, we sold that home for twice as much as we paid. So, so from '97 to '02, '98 to '03, we were seeing 100% appreciation.
Yeah.
And so what started happening then in the 2000s, and that sort of got this ball rolling even a little faster downhill?
Sure. Well, when we all thought the world was going to end on January 1st, 2000, it turns out it didn't. 30-year fixed rates were hovering between 8.5% and 9%, which today seems astronomical, but they were trading in a trough in the late 1990s between the high 6s, low 7s, up as high as 9%, and they would kind of go in a sort of undulating motion. And when this century started, they were right around between 8.5% and 9%, and they started a real slow decline, a slow but steady decline between 2000 and about 2004. 2004 to 2005, they had really hit bottom and then ticked up a little bit. So the combination of easy credit and steadily lowering rates, I think, really helped to fuel the push for home prices in the early part of the 2000s.
And so, and then couple that with what was going on at Wall Street at the time, and maybe you can talk about that a little bit, and the bundling of these loans, and now we have new investment products that are being sold and making lots of people money on Wall Street. And
well, in the early part of the 2000s, we really saw the dawn of a lot of different mortgage products that hadn't been around, some exotic financing. Things like stated income loans, no income documentation loans, loans in excess of 100% of the value of the property, interest-only loans. They had been around in different ways, shapes, and forms over the last 20 years, but not really hitting a critical mass like they did in the early part of the 2000s. Then they became packaged and sold on Wall Street, and as the chickens came home to roost and the people who actually had those mortgages in those pools that were sold on Wall Street stopped paying their bills, stopped paying their mortgages, those pools of mortgages didn't perform, and the ratings on them didn't reflect what the true risk was in those pools, and that kind of led to a lot of the collapse in the housing market in I think it was 2007.
Yeah, March of 2007. I remember it well. And one of the things in talking with you about a month and a half, and then outlook for the real estate market in general.
I see it positive. I mean, prices have come down a little bit from where they were from the high points, depending upon the market. Most of the markets around Greater Boston have relatively held their value pretty well. Certainly not at maybe 2004, 2005 levels. You can speak more to that, but. We've seen the areas mostly around Metro Boston stay fairly strong. Interest rates are certainly low. Currently a 30-year fixed rate should, for most people, depending upon their credit and down payment, is trading around below 5%. So certainly there's a great affordability. Credit is available. If you can qualify for a mortgage and you can demonstrate that you can pay it back, then there's definitely money available. So it really is, I mean, the cliche is it's always a great time to buy a house, but it really is a great time to buy a house because there's plenty of deals to be had, and there's good availability of money, and the price is right.
What's the difference if I have a credit score of 600 and you have a credit score of 700? What's the difference in the interest rate that I would get as opposed to you?
Well, it varies for every consumer. There's a lot of different factors that go into it, but one of the big changes that we've seen is that Fannie Mae and Freddie Mac and FHA as well have put on different adjustments based upon the interest rate that people would qualify for. It may be as little as an eighth, it could be as much as a quarter real difference in interest rate. But generally, the better your credit score, the better rate you're going to get.
Yeah, and so I think it comes back, people need to really be looking at their credit score, correcting any problems that might be there. I often find that someone will come in and say, geez, I have bad credit, and when I look at it, there's just some minor things that can be corrected to help improve this score.
Well, the good thing is that there are some fantastic tools out there that are available to us in the mortgage business to help people with that. We've got different scenario analyzers that we can take a look at, and let's say you did have a 600 credit score. We just had a situation with my company last week where we had someone that all had to do was pay off one credit card for $63, and their credit score went up by about 50 points. And 50 points could be the difference between you qualifying or not qualifying, or getting maybe 5.25% or 4.875.
Yeah,
it just depends. There's a lot of different factors.
That's great to know. I think a lot of people sometimes, they kind of run away from that, and with a little bit of help, they can get that credit score up, get approved, save money, etc. That's great to hear. A while ago, you recommended this book. This book is written by Michael Lewis. It's called The Big Short. Michael Lewis wrote The Blind Side, and Moneyball, I think, was a big book of his. And so if you really want to get an understanding of what happened, I think we talked about from Main Street to Wall Street and how this all came about. This is a great read. Gives you a good understanding, and it's interesting to see how it happened and how it impacted different companies. Why was a company like AIG impacted so negatively when this all happened, and it's explained here. And basically, they were the only ones writing insurance on these pools of bonds that were basically junk, but they thought they were okay because the rating agency said they were AAA rated, and so it was a lot of different components going on. And when those people started defaulting on those loans, it caused a lot of problems for a lot of people down the chain, and quite frankly, we're living with that today, right? So what do you see moving forward here?
There have been a number of changes, and you kind of referenced it when you said from Main Street to Wall Street. A lot of the problems originated on Main Street with really lax standards as far as licensing and education of professionals who are in the mortgage business. I think the level of professionalism in the business dropped quite a bit from the time that I first got in it, where it was really more of a financial advisor type position to everyone was getting into it when the money was good in the early part of the 2000s. Licensing has really tightened up the standards for qualification for people to get into the business. business have really tightened up. There's a lot more education and continuing education that's required. So the propensity for people to jump into the business, make money when things are good, and then get out, that's pretty much gone by the wayside.
A low point in the market as we came out of the late 80s, early 90s recession, which was real estate based. So, you know, where do you see this problem beginning, and kind of give us maybe a little timeline on that?
I think in the end it'll be a good thing for the consumer. So what we've seen is there's a lot better quality, more professional people in the business right now. Some of the elements that I think were harmful to consumers have been legislated and regulated out of the business. There's a lot more changes on the regulatory front that have affected things. The standards for credit quality are higher. It's more difficult to get qualified for a mortgage if you can't pay it back, oddly enough. And there have recently been some significant changes in the mortgage business as of the beginning part of April of 2011 that drastically changed the way people in the mortgage business get paid. You don't get paid anymore based upon the interest rate on the loan. You only get paid based upon the loan amount, with the idea that that takes any incentive for the loan originator or mortgage broker to make any more money by trying to steer someone into a product that really isn't good for them, or into an interest rate that really doesn't benefit them. Well, when I got in the business, I think I was too new to understand what we were dealing with. That it was a low period. I didn't really have enough background to compare it to anything, but I do remember things being a lot like they are now. And I kind of compare the real estate business and the mortgage business as the pendulum of a clock. And I think when I got in, the pendulum was swung far to one side. Now the pendulum is swung all the way to the other side, and now we're back to where we were when I started.
To 1993.
Yeah. I think, yeah, probably the early 2000s, the pendulum was at the opposite end of the spectrum for where it was when I started 10 years earlier. So where I see things